Welcome to the Explainer. So, if you're looking to wrap your head around the absolutely massive paradigm shift happening in the finance and accounting industry right now, you are in the exact right place. We are looking at a fundamental, ground up transformation in how audits, financial planning, and just routine accounting are getting done. And we are going to break it all down for you today, step by step. Let's dive in.
Let's kick things off with a number that honestly kind of blows my mind: 60%. According to a recent industry analysis, finance professionals, especially folks in FP&A and audit, are currently wasting up to 60% of their entire week just wrestling with routine data collection and formatting. That leaves just a tiny fraction of their time for actual high-value analysis. I mean, think about that. More than half of a highly trained professional's week is spent just manually moving data around.
And look, if you've ever been an entry-level finance pro or a junior auditor, you know exactly what that exhausting reality feels like. It's eating cold takeout at midnight, right? Crunching numbers, staring at endless spreadsheets until your vision literally blurs just trying to track down some 3-cent rounding error. It's a heavy, heavy burden. It leads to serious burnout, and frankly, it is just not the highest and best use of a human brain. That manual drudgery usually looks like the standard audit procedures that have historically bogged down entry-level staff forever. Under global accounting standards like ACCA, we're talking about mind-numbing tasks, tracing literal mountains of sales invoices back to their dispatch notes just to prove occurrence, reconciling endless supplier statements to the payables ledger, or, manually recalculating depreciation across a massive fixed asset register. We're doing those incredibly tedious inventory cutoff tests to make sure goods are matched to the right accounting period. But here is where the entire story shifts. Recent industry insights have hit the nail on the head with this idea. The biggest change happening right now isn't AI coming in and replacing roles. It's compressing the time it takes to do the first draft of all this finance work. This is so absolutely crucial to understand. AI is the ultimate catalyst here. And no, it isn't stealing your job. What it's doing is drastically shrinking the time you need for all that initial data preparation, the variance reporting, and the mundane reconciliations. And when we say shrinking the time, we're talking about taking days of unstructured data work and turning it into tasks that take mere seconds on a stopwatch. It's wild. Modern AI platforms are getting incredibly good at taking unstructured text, news, filings, earnings calls, and immediately turning it into structured signals. Detection models spot patterns across massive data sets instantly. What used to be a week-long reconciliation project is basically a push of a button now. So this builds a completely new dynamic. On one side, you've got the traditional junior auditor manually matching those invoices to dispatch notes. It's slow, it's exhausting, and let's be real, it's highly prone to human error. But on the other side, the AI-augmented auditor lets the system handle that basic reconciliation in seconds, so the human's role shifts entirely. You step in to investigate the anomalies. You provide strategic risk advisory. You basically go from searching for the needle in the haystack to figuring out why that needle is there in the first place. Naturally, this shift requires a totally new skill set. We are moving away from manual data entry and shifting over to prompt engineering, using structured frameworks to ask an AI to extract what you need. We're moving away from writing out basic, repetitive variance commentary like typing "revenue was up due to enterprise bookings" over and over, and moving toward leveraging real predictive analytics. And we're ditching routine ledger checks for high-level fraud and anomaly detection. The whole baseline of what it means to be a finance professional is actively leveling up. Which really brings us to the new baseline for human value. If the AI is doing the busy work, your true value skyrockets to the very top of the chain. And that value relies heavily on two things: contextual knowledge and professional skepticism. Contextual knowledge is vital because the exact same financial data point can mean entirely different things depending on the market or the business setup. And professional skepticism, that questioning mind, that critical assessment of evidence, a machine simply cannot replicate that. You still have to challenge management's assumptions and verify the realities on the ground. To really prove exactly why your human judgment is so irreplaceable, let's look at a classic trap from advanced audit frameworks: the difference between audit risk and business risk. It is the single biggest stumbling block for students, and ironically enough, it's the exact same mistake an unguided AI will make. Business risk is the commercial risk that a company fails to meet its objectives, but audit risk is the risk of a material misstatement in the financial statements. An AI will naturally read a scenario and list everything going wrong commercially, but a human auditor has to translate that into how it actually breaks the financial reporting. Think about it like this. If a client launches a highly risky new product, the obvious commercial business risk is that customers might not buy it, right? An unguided AI is going to spot that trend instantly.
But it takes your contextual understanding as a human auditor to realize the true audit risk. If the product doesn't sell, the inventory's net realizable value drops below cost, which means the balance sheet valuation is overstated. The AI spots the business trend, you identify the financial misstatement. Yet despite this incredibly clear roadmap for the future, recent data from Deloitte reveals a massive, massive gap. While tons of departments are experimenting with AI, a staggering 84% of finance functions have not yet redesigned their jobs or workflows around it. Only 16% have. The tech is here, the tools are sitting right there, but workforce strategy is totally lagging behind. Organizations have to start building workforce transformation centers to actually adapt these roles. So I want to pose a question to you directly right now. When you look at your day-to-day tasks, are you acting as a manual checker or are you a strategic advisor? Because those manual checking jobs, they are being compressed to zero. The strategic advisors, the folks who use AI to generate that first draft so they can spend their time actually analyzing anomalies and questioning management, those are the professionals who are going to thrive. And we've got to remember the golden rule here, something you see in all the recent trend reports. AI is a co-pilot, not an autopilot. It is absolutely not flying the plane for you. Humans must still govern the assumptions, apply their business judgment, and 100% own the final decisions. Explainable, governable AI augments your capabilities. It does not replace your professional responsibility. So I'm going to leave you with this final thought to chew on. If AI can instantly write the first draft of your audit or your variance report or your reconciliation, what incredible value are you going to build with the final edit? Because that final edit is where your career is made now. The drudgery is over. The era of the automated audit and AI-augmented finance is officially here. It's time to step up, upskill, and build the future of finance. Thanks for hanging out with me on this explainer, and keep learning. Let's dive right into this explainer. AI is absolutely transforming the automated audit as we know it. Check this out. 31% of finance job postings now explicitly require AI or machine learning skills. Which begs the terrifying question, is your specific accounting role about to be fully automated? The pressure's definitely on. AI requirements for traditional accountants just surged a massive 67% year over year. Right now, you're probably wasting 60% of your week just collecting data rather than analyzing it. But AI flips the script, instantly compressing the time it takes to knock out that first draft. The old manual grind? Gone. AI auto-generates those repetitive variance narratives in literally seconds. Look, if you're just matching invoices all day, AI will replace you. It's a totally losing game. The game changer is in data prep. AI turns messy, unstructured earnings calls into highly structured signals. Routine stuff like categorizing expenses or analyzing vendor payments, handled easily by a simple AI prompt. So you must pivot. Ditch the data entry and focus heavily on anomaly detection and risk advisory. Auditors are leveraging AI for heavy forensics, easily applying rules like Benford's Law to hunt down fraud. Wildly enough, studies show AI predicts earnings fluctuations way more accurately than highly trained professional analysts. These models are beasts at spotting hidden anomalies across massive data sets that we humans just completely miss. But here's the catch. AI is a co-pilot, not an autopilot. You still have to govern the assumptions. Your real superpower is contextual judgment. That's a uniquely human strength, completely locked within your institution. You're the one distinguishing a broad commercial business risk from a genuine financial audit risk. Only you can apply nuanced audit logic to link those facts directly to complex financial valuations. That's how you add real value, identifying control weaknesses, recommending strategy, and actively managing crisis responses. But crazily, 93% of corporate AI budgets go purely to tech, completely ignoring human workforce training. Never forget this. It's humans who create the enduring competitive edge, definitely not the tech itself. So will you automate your workflows before AI automates your role? What's your next move going to be?
Welcome to This Explainer. We're going to expose the biggest financial management exam lie that guarantees a failing grade. Okay, let's dive into this. Thinking profit maximization is the ultimate goal? Total myth. It'll kill your grade. If you write that profit is the main goal, you'll literally fail. The real answer? Shareholder wealth. And this brilliantly illustrates why.
Profit totally ignores timing, risk, and cash flows. Plus, it's way too short-term.
Now, what's really interesting about this slide is the true focus, maximizing the actual market value of shares.
So the crucial point is this. Every single decision you make absolutely must boost that share price.
Don't lose crucial points over a silly trap. Want to absolutely guarantee a pass on that FM exam?
Then grab my FM notes right now. Are you ready to stop guessing and master your financial decisions?
Welcome. Okay, let's dive into this huge, grade-tanking financial reporting exam mistake together.
Are you bleeding critical exam marks because of this common trap? Let's fix it right now.
See, students constantly treat a depreciation change as a prior period error that totally wrecks their scores. But look at IAS 8. Changing useful life or depreciation methods, that's strictly an accounting estimate. Now, what's really interesting here is the strict contrast between rigid policies and flexible estimates. And this brilliantly illustrates it. Policies and errors demand retrospective restatement, but estimates? Nope. So the crucial point is this. An estimate change just needs prospective application from the current year. Let's see how this builds a super simple, foolproof 3-step method to save your exam marks. Never restate your depreciation changes retrospectively. Depreciation is an accounting estimate, not an accounting policy. So you must only apply the change prospectively from the current year. Download my paid FR notes today. You literally have the exact formula to beat the examiner's trap now. Just execute it quickly. So, will you remember this golden rule and properly apply IAS 8 when the pressure's actually on? Hey there, today's explainer is all about dodging a massive trap in the ACCA exam. Look, failing by just a few marks from silly mistakes is literally the worst. Let's fix that. The historical pass rate hovers around a brutal 39%. It's tough, but you totally got this. Examiners consistently hand out flat zeros when students fall into one specific, totally avoidable ethical trap. We all know the SSFI threats, right? Self-interest, self-review, advocacy, familiarity, and intimidation. But here's the catch. Just writing down a threat like familiarity? Nope, not enough to score. So why the zero? What absolutely crucial element is missing from your exam answer? The fix is incredibly simple. Stating a threat alone fails. Always pair it with a safeguard. What's a safeguard? It's just a specific action that reduces that threat to an acceptable level. Secure those easy points. Use specific actions, like rotating key partners or requiring independent firm reviews. Applying this formula literally takes seconds, but it absolutely guarantees you those easy marks every single time. Never just name an ethical threat in your ACCA exam. You will lose easy marks unless. Also write down a specific safeguard to reduce that threat to an acceptable level. Download my paid AA notes. You've got the winning framework now. So, will you let a missing safeguard cost you your exam?
Let's talk about the absolute biggest mistake that'll completely wreck your financial appraisals and your exam scores. Because forgetting the tax shield in WACC overstates your cost of capital and rejects positive NPV projects. ACCA examiners flag this constantly. Skipping just one simple multiplication makes your discount factor way too harsh. So never fall for the trap of using that pre-tax coupon rate. You absolutely must adjust for tax. Since interest is tax deductible, here is the golden rule. Always use the post-tax cost of debt.
Even pro valuation software literally demands the marginal corporate tax rate so you don't overstate your WACC.
So, will your next calculation build wealth or completely destroy it? Grab my paid FM notes.
So, the absolute fatal WACC mistake in fair value reporting? Using book values instead of market values. You literally have to weigh debt and equity at market value, or your whole NPV calculation just collapses. Sure, analysts default to easy book values, but strict accounting regulators absolutely demand market values for accuracy. So, are you struggling to defend a highly subjective WACC calculation when the auditors come knocking? Well, that weighting error, just the tip of the iceberg. There are actually 7 critical reporting mistakes. These nasty traps include an incorrect risk-free rate, inconsistent beta estimations, or a mismatched market risk premium. Plus, analysts misjudge the cost of debt, totally neglect crucial tax shields, or completely overlook country risks.
Enter the Whack Finder Blueprint. It's a methodology by Seong-Young designed specifically to eliminate these exact valuation headaches. The core philosophy here? Ditch those subjective historical guesses. Fair value demands objective, arm's-length market rates. The blueprint lays it out. Match cash flow horizons, estimate beta accurately by industry, and apply marginal taxes. Fixing these errors generates an ironclad cost of capital, guaranteed to pass those strict accounting regulator reviews. To actually put this into practice, the creator offers a free 30-minute discovery session to implement these strategies. Which leaves one absolutely critical question. Are incorrect WACC inputs secretly causing your M&A deals to destroy value?
Welcome to The Explainer. Today, we're diving into a high-stress scenario that, let's be honest, almost everyone in finance eventually has to face. We're talking about explaining a sudden, unexpected revenue drop to the board. And specifically, we're going to look at how to navigate this incredibly intense situation without relying on confusing, defensive accounting jargon that, frankly, just ends up hurting your credibility. So let's kick things off with a question that pretty much strikes fear into the heart of every single FP&A professional out there. Have you ever missed a major forecast? You know that dreaded moment, right? The actuals come in, they fall way short of your projections, and suddenly, boom, every eye in the room is looking directly at you for an explanation. The pressure just shifts entirely onto your shoulders. And man, the psychological toll of that moment can be absolutely immense. Just look at how one Reddit user vividly described this reality, basically having full-on FP&A panic attacks. Because, you aren't just dealing with spreadsheets in a vacuum here. You're dealing with sky-high expectations, massive executive pressure, and the very real panic of explaining why a highly anticipated target was completely missed. It's a universal experience for anyone who owns the numbers.
The thing is, being a key influencer in your company means the stakes are literally as high as they get. Like this user pointed out, when your analysis influences a major business decision and you get it wrong, well, you better have your ducks in a row. You can't just throw your hands up and say, oops, the model's changed. You're the one guiding the business through uncertainty. That makes clear, structured communication absolutely crucial, not just for your own professional survival, but for the company's entire long-term success.
Okay, moving into part one, the trap of defensive jargon. Because honestly, our natural instincts in these high-stress moments, they're almost always wrong. Just look at the sharp contrast here between the old way of handling a miss and the new way. The old way was basically hiding, dumping 50 slides of raw data onto the board, focusing purely on compliance and granular variance analysis. It's super defensive, like you're trying to prove you did the math right, even though the outcome was totally wrong. But the new way, the required way from modern financial leaders, that's all about strategic partnering and narrative storytelling. You really have to move from just reacting to what happened to proactively driving the strategy of what happens next. And if you don't make that shift, your message is just going to fall flat. When you rely on defensive jargon to explain a revenue drop, executives literally just tune out. They are incredibly busy people. If they don't instantly understand a technical term, they're way more likely to just stop listening altogether rather than pause the entire meeting to ask you for clarification. So by using all those big words, your core message is effectively canceled out by your own vocabulary. Crazy, right?
This brings us to part two. Lead with the bottom line. Let's fix this communication gap. To restructure how we deliver this kind of bad news, we need a technique designed specifically for time-pressed executives. It's called bluff, or bottom line upfront. Simply put, this means you state your main insight or recommendation right out of the gate, way before you dive into any background context or massive data tables. Instead of making the board wait in suspense for the bad news while you walk them through your methodology, you hit them with the bottom line first. It completely shifts the room's energy from anxious suspense to focused problem solving. Check out this example. Opening with a direct, plain-spoken headline, like, "We recommend a 10% reduction in discretionary operational expenditures," engages your audience immediately. Notice you aren't just saying revenue dropped. You're actively stating, here's the reality, and here's our proposed solution. Once they hear that headline, they have a solid anchor. They know exactly where the conversation is heading, which makes them way more receptive to the details that follow. And then, you back up that brilliant headline with the rule of three. Step 1, you state the headline, your bluff. Step 2, you present exactly 3 supporting drivers that explain the why behind those numbers. Grouping info into threes just makes it so much easier for the board to digest and remember when the pressure is on.
And finally, step 3, end with a clear recommendation. It's pretty much a perfect, concise narrative structure that keeps the conversation from spiraling into the weeds. All right, let's dive into part 3. Translate numbers into narrative. How do we actually reframe those defensive technical terms we talked about earlier? The translation into plain English is actually incredibly simple once you get the hang of it. Instead of saying EBITDA margin compression, which, let's face it, kind of sounds like an excuse, you simply say profit per dollar of sales is shrinking. See the difference? By doing this, you instantly frame the insight around the stakeholder's actual priorities. You're speaking their language, not yours. You take all the friction out of the conversation so the board can focus on the real business impact instead of trying to decipher your accounting mechanics.
You can even take this a step further by using analogies. Say you're explaining a leveraged balance sheet that contributed to a crisis. Don't just robotically say high debt-to-equity ratio. Tell them it's like carrying 2 backpacks instead of 1. Using a simple visual metaphor like this brilliantly bridges the gap between abstract numbers and tangible reality. It makes the weight of the situation immediately relatable, so non-finance folks can truly feel the impact of the data.
Now, I know some finance professionals worry they're watering down their analysis when they do this, but keep this quote in mind. The goal isn't to reduce accuracy. The goal is to increase clarity. Simplifying your language absolutely does not mean dumbing down the finance. It means you're empowering the rest of the business to actually understand the miss so they can jump in and help fix it. At the end of the day, true clarity is the ultimate marker of a real subject matter expert.
Moving on to part 4, the final step. End with clear recommendations. If you want to give the board agency and direction instead of accidentally starting a panic, you need to use the 1-3-1 method. This is a game changer of a framework for pivoting from the bad news of a forecasting drop straight into a strategic, forward-looking solution. Here's how it works. You start with one core question the business faces because of the drop. Then, you present 3 viable options to recover. And lastly, you deliver one clear, unambiguous recommendation on which path to take. It stops endless debate in its tracks, prevents decision paralysis, and completely forces executive alignment.
But hey, as you deliver that recommendation, your word choice matters immensely. You really want to avoid weak, hesitant phrasing like "we think" or "we kind of believe." Actually, scratch that. Just don't use those at all. Instead, use confident, direct language like "we recommend" or "we propose." This simple tweak ensures your financial storytelling leads to definitive decisions and decisive action from leadership. It positions you as a strategic advisor, not just a reporter dropping off bad news.
As we wrap up this explainer, I really want you to internalize this concept. Data alone doesn't trigger decisions, stories do. The raw numbers of a revenue drop, they only tell people that a fire has started somewhere in the building. But context, plain language, and a structured narrative, those are the vital tools that will actually guide your company safely out of that burning building and through the uncertainty. So, I'll leave you with this provocative thought to ponder before you walk into your next high-stakes boardroom presentation. Next time the numbers drop, and let's be real, they will drop eventually, will you hide behind a 50-page deck of defensive data, or will you step up and lead the narrative? The choice is entirely yours, and honestly, it just might define your career.
Okay, let's dive into this explainer on surviving a total corporate nightmare, explaining a forecasting miss to your CEO.
Like one Reddit user joked, these executive reviews can seriously trigger a full-blown panic attack.
So, when your numbers actually fall short, how do you break the news without totally losing their trust?
Well, never say you missed due to an accrual true-up. That jargon just creates frustration and distance.
You've got to understand what's in it for them. CEOs care about actual business impact, not accounting mechanics. The fix is a vocabulary shift. Translating that dense jargon into plain language bridges the gap instantly.
Crazy enough, most finance pros still spend 75% of their time just pulling data, ignoring storytelling.
To survive, you need a bulletproof narrative. State your headline, give 3 drivers, and make a clear recommendation.
Always use bottom line up front. Time-pressed execs need the ultimate outcome literally right away.
Next, the rule of 3. Grouping the why into 3 digestible drivers totally prevents overwhelming your audience.
Take James, a finance director who was absolutely terrified of presenting a massive cash shortfall.
Instead of hiding behind dense spreadsheets, he used radical clarity to face the board head-on. He stated the problem directly and immediately signaled that actionable solutions existed to fix it.
He wrapped up with confident language, saying, "We propose pausing is way stronger than a hesitant we think."
Ultimately, this storytelling approach transforms you from a back-office reporter into a real-time strategic value creator.
So when your next forecast misses, will you just read the autopsy report or will you command the room?
Let's talk about a total game changer for management accounting, the high-low method.
Can't figure out your fixed versus variable costs?
Yeah, it's annoying, but we'll fix it fast.
Don't fall for the classic exam trap. Never use the highest dollar cost. Always grab the highest activity level. So if 1,000 units cost $5,000 and 500 costs $3,500, just divide the differences.
It literally takes seconds. Want to crush your exam? Grab my MA notes right now and go pass.
Never forget to depreciate your right-of-use asset. Under IFRS 16, you must depreciate the ROU asset completely separately from the lease liability, or your final profit will be Hmong. Grab my paid FR notes. Are you making a fatal mistake on your audit and assurance exam? Let's fix that right now. Applying CAMs universally is a massive trap. Honestly, it's costing your easy, crucial exam marks every single time. Okay, let's dive into this. Under ISA 701, a CAM is simply the most significant audit issue. Basically, a CAM describes exactly why an issue mattered and precisely how the auditors handled it. But here's the thing. Examiners constantly complain that students fundamentally misunderstand when a CAM-LAM is actually required. Never assume key audit matters, or CAMs, are required for every single audit. CAMs are strictly only required for the audits of listed public interest entities. So do not use them for private companies. Grab my paid AA notes. So what other audit report modifications are you getting completely wrong? Let's find out.
Okay, let's dive into this. Welcome to the Explainer. Today, we're fundamentally shifting gears. We are absolutely not treating this session as some standard run-of-the-mill exam tutorial. No, we're treating this as high-stakes executive CFO training. We're going to look really closely at the Advanced Financial Management Syllabus, AFM, and dissect a very specific psychological hurdle that trips up incredibly smart people. It's something we call the perfectionist trap. And look, learning to overcome this isn't just about passing a paper. It's literally about learning how to operate like a strategic finance leader under immense pressure.
So I want to pose this question directly to you right out of the gate. Why do brilliant, technically gifted accountants fail the AFM exam? I mean, think about it. These are candidates who have completely mastered complex double-entry bookkeeping, they've navigated grueling tax legislation, and they know their formulas inside and out. Yet when they hit this specific strategic level, something just breaks down.
And the reality of that breakdown is incredibly stark. The global pass rates for strategic-level exams like AFM typically hover right around that 40 to 50% mark. That is a notoriously tight bottleneck. It's a stark reminder of the level of preparation required, but it also tells us that technical knowledge alone is simply not enough to cross the finish line. The examiner is filtering for something else entirely.
To understand what that something else is, we kind of need to shatter a massive illusion. ACCA expert tutor Andrew Moore has this brilliantly counterintuitive piece of advice for exam day. He says, don't worry about making your calculations perfect. Now, if you're a trained accountant, hearing that probably feels like fingernails on a chalkboard, right? Your entire career so far has been built on balancing things to the exact penny. But at the strategic level, that obsession with mathematical perfection is exactly what's going to sink you.
Picture the exact moment the trap snaps shut. This is the perfectionist trap in action. You're in the exam. The clock is relentlessly ticking, and you encounter a calculation, maybe something involving complex hedging or a really convoluted free cash flow variable. And it is, by design, nearly impossible. Very few students are going to get it right. A perfectionist? They'll freeze here. They'll put their head in their hands and spend precious, unrecoverable minutes trying to solve an unsolvable puzzle, completely paralyzed, instead of acting like a decisive leader.
There's a really stark contrast between these two mindsets, and understanding it is basically the core of this explainer. On one side, you've got the tactical bookkeeper. This person obsesses over the raw numbers, terrified to move forward if the spreadsheet doesn't perfectly balance out. On the other side, you have the strategic CFO. The CFO knows that in the real world, well, you rarely have perfect information. The CFO uses estimates, makes a call based on commercial acumen, and keeps the whole business moving forward. Ultimately, the examiner wants to see if you can be that CFO.
The fatal consequence of that bookkeeper mindset is poor time allocation, and it will absolutely destroy your exam chances. Think about it. If you spend 80% of your mental energy and time wrestling with one single 10-mark calculation, you're leaving only 20% of your time for the entire rest of the paper. Metaphorically, this is just terrible executive time management. You're ignoring the broader strategy of the business just to fixate on a single stubborn operational detail.
This brings us to a crucial mechanic you absolutely must understand: the own figure rule. This is a marking system where you're awarded subsequent marks based on the logical application of your prior calculation, even if, and this is key, even if your initial baseline number was a complete incorrect guess. And look, this isn't just some neat little exam hack. It's a brilliant reflection of boardroom reality. In the real world, your initial assumption about a new market might be completely wrong. But if your strategic logic and business response to that assumption are flawless, you are still demonstrating high-level executive capability. So let's see how this builds into an exact actionable procedure. When you hit that wall, when you find that totally impossible calculation, here is your CFO protocol. Step 1, make a logical estimate. Just invent a sensible number. Step 2, state your assumption clearly so the examiner knows exactly what you're up to. Step 3, apply that number to the rest of the problem and confidently move forward. And Step 4, claim those method marks using the own figure rule. Show your workings and you're going to be rewarded for your process, even if the starting math was completely fictional.
Now, the absolute most crucial element here is time. 1.8. That is the exact number of minutes you have per mark in a standard 3-hour and 15-minute ACCA exam. 1.8 minutes. That ticking clock perfectly mirrors the finite, relentless nature of time on a real-world CFO's desk. You simply do not have the luxury of spending 20 minutes staring at a single variance. You've got to respect the clock, allocate your resources efficiently, and just keep pushing forward.
Moving on to our next section, commercial acumen over math, the true test.
The examiner is definitely not testing your ability to function as a human calculator. They are testing your commercial application. They want to know if you can look at a set of numbers and instantly understand what they mean for the survival and growth of the business. A massive pitfall students make here is treating these professional skills as a sort of bolt-on accessory. As the source material really highlights, professional skills are not a separate task. Actually, scratch that. It's more like a completely integrated mindset. You can't just crunch numbers for 3 pages, tack on a weak little skepticism paragraph at the very end, and expect to pass. That is not how leadership works. Commercial awareness has to be woven into the very fabric of your entire answer.
So here is exactly how you demonstrate that executive capability and actually secure those professional marks. First, you need to challenge assumptions while you're doing the calculations. You must explain the business impact, never just hand over a raw number without context. Tell the board what that number actually means for their strategy. You've got to show insight and risk awareness. And finally, present the whole shebang in a clean, professional report format with clear headings. Basically, make it easy for the examiner, acting as your CEO, to read and understand your advice.
When the pressure really hits and you feel that perfectionist paralysis creeping in, I want you to anchor yourself to Andrew Morris' highly memorable catchphrase, just keep swimming. If calculation's taking too long, make something up, state your assumption, and literally just keep swimming. It is all about relentless forward momentum. Surviving the exam pressure requires the exact same resilience as surviving a volatile fiscal quarter.
Okay, let's summarize your new executive directives with the CFO playbook. Number 1, always link your calculations directly to the broader business strategy. Number 2, trust your commercial judgment way over flawless arithmetic. Number 3, respect the ticking clock. Always remember those 1.8 minutes. And number 4, never ever leave a blank page. An unattempted question scores a 0, but a logical, structured attempt, even with completely estimated numbers, grabs those partial marks that are so often the difference between a fail and a pass. I'm going to leave you with this final provocative thought to really cement this mindset shift. If you were the actual CFO of a multinational company right now, right in the middle of a crisis, would you really spend 20 minutes staring silently at a broken spreadsheet? Or would you make a calculated call, trust your professional judgment, and lead the business forward? The choice is entirely yours. Use this explainer to conquer your preparation and go act like the executive you're training to be.
Think producing way more stuff automatically means higher profits? Nope, you're falling for a massive accounting illusion.
Okay, let's dive into this. Crazy as it sounds, under absorption costing, it actually does. See, marginal costing expenses your fixed overheads immediately.
But absorption? Profit magically rises when inventory increases.
Here's the trap. Those fixed overheads literally get hidden inside your massive closing inventory. It's a total mirage.
Don't get tricked on exam day. Master MACA and pass with total confidence using my paid PDF notes.
The absolute bedrock of contract formation is exchange. For an agreement to be legally binding, value must move in both directions, a requirement the law calls consideration. If you look at these two contract parties, you can see what happens when value flows only one way. If one promises a benefit but receives nothing in return, that promise holds no legal weight. Under strict common law, a one-sided pledge is completely unenforceable. This creates a strange friction when dealing with existing debts. Imagine a creditor explicitly promises to give a struggling debtor a break, lowering the required payment to clear the balance, but asking for nothing extra in return. Because the debtor provided no new consideration for this discount, it raises a critical question. Can the creditor wake up the very next day, retract the discount, and legally demand the original, full amount? Strict contract law says yes. The creditor can ruthlessly break that promise. But allowing that would destroy vulnerable businesses. To prevent this, the legal system relies on a hidden, equitable mechanism. The courts were forced to confront this exact problem during the chaos of World War II, culminating in a specific property dispute in London. In 1937, a landlord leased flats at a high rate. During the 1940 Blitz, the buildings emptied. To avert bankruptcy, the landlord promised a 50% rent reduction. Relying strictly on this promise, the tenant altered their position to survive. Fast forward to the end of the war. The flats reached full occupancy again. The landlord looked at the books and attempted to retroactively collect the full, undiscounted rent for those entire war years. Their legal argument was mathematically flawless. The tenant never provided any new consideration for that 50% discount. Therefore, under strict contract law, the promise to accept less was technically never legally binding. The courts had a problem. Enforcing the rigid rules of commercial contracts would bankrupt the tenant, violating the basic fairness required in business dealings. To solve the high trees paradox, the court bypassed common law and applied an equitable doctrine, promissory estoppel. First, one party makes a clear promise to accept less, intending for the other to act on it. Second, the receiving party relies on that promise to their detriment. The court then physically blocks, or estops, the promisor, freezing the landlord's retroactive payment. However, this rule has a strict boundary. It acts as a shield, not a sword. It only suspends legal rights during the period of reliance. Once the war ended and conditions returned to normal, the landlord could charge the full rent. Promissory estoppel bridges the gap between strict law and equity. It takes a seemingly empty promise and converts it into a legal constraint. If you induce someone to rely on your word, that reliance will trap you just as tightly as any signed contract.
Stop letting past mistakes ruin your future. Today, we're diving straight into the sunk cost fallacy.
Listen, in business, any money you've already spent is just gone forever. Period.
So stop trying to save a failing project just because you poured cash into it.
You absolutely must ignore sunk costs and only look at future incremental cash flows to make decisions.
Let go of that sinking ship. And hey, grab my paid notes to pass your exams.
Let's dive into this explainer. Ready for the ultimate AAA exam trap that costs students critical marks?
So think about it. Are key audit matters required in every single listed company audit report?
Well, many students fall into a huge trap. They completely mix up modified opinions with key audit matters. First up, key audit matters. ISA 701 defines them as the most significant issues in an audit.
A KAM outlines exactly why a matter was significant and how the auditor tackled it using solid evidence.
Now, the disclaimer of opinion. This hits when you simply cannot get sufficient appropriate audit evidence.
Because this lack of evidence is so pervasive, the auditor literally just states, "We do not express an opinion." Right, so this brilliantly illustrates a massive fundamental clash between these two distinct auditing concepts.
A CAM requires highlighting evidence, but a disclaimer literally means you are unable to get any evidence. Let's think like an auditor. Could you possibly report significant findings if you have absolutely zero evidence?
Exactly. No way. It's a logical impossibility to detail audit procedures for a pervasive lack of evidence.
So,
Here is the absolute golden rule for your exam. If there's a disclaimer, there is no CAM. Disclaimers of opinion mean you have no evidence, so adding a key audit matter is strictly forbidden. Download my paid AAA notes.
Lock this rule in. What other hidden reporting traps are buried in your audit scenarios? Stay curious. Management letters prove absolutely nothing. Seriously, don't fall for this massive audit trap in your exams. Management confirms all liabilities are recorded. So does that mean our testing is totally finished? Nope, wrong. Here's the catch. Written representations, they're literally just management confirmations, nothing more.
Under ISA 580, it's just a statement. It never ever replaces actual hard audit evidence.
You always need independent substantive procedures. Never just take their word for it. Here's the golden rule. Written reps only confirm what they're saying. They aren't evidence.
So what do you actually have to do to secure those marks? You still got to test those payables, reconcile statements, check post-year-end invoices, and run cutoff tests. Remember the hierarchy. External evidence is king. Internal management inquiry, literally the least reliable.
But wait, what if management flat out refuses to sign the rep letter? What then?
Talk to governance and modify that audit opinion immediately. It's a massive limitation of scope. That severe lack of evidence leads straight to a qualified opinion or even a full disclaimer.
The takeaway? Think like a real auditor, apply the standards, and stay incredibly skeptical.
Want to pass with total confidence? Master AA with my paid notes.
All right, let's dive into a massive financial reporting trap that literally catches everyone completely off guard.
Are you calculating asset impairment completely wrong? You estimate those future cash flows absolutely perfectly?
Then you compare them to the carrying amount and immediately recognize a massive impairment loss.
But wait, here's the catch. You forgot to discount those cash flows. Value in use requires present values.
So why does this matter? Well, under IAS 36, an impairment loss happens when carrying amount exceeds recoverable amount. The trick is finding the recoverable amount. It's simply the higher of fair value or value in use. And boom, right into the trap. Valuation in use strictly means taking the present value of future cash flows. You have to take all those future cash flows and discount them back to today. No exceptions.
But hey, what actually triggers this whole complex review process in the first place?
Look out for huge red flags, like sudden market declines, obsolescence, or actual physical damage to your assets.
If one machine doesn't make cash on its own, you test the entire cash generating unit, or CGU. Got a loss? Always wipe out goodwill completely first, then reduce your other assets pro rata. But be super careful here. Never, ever reduce an asset's value below zero, or its fair value.
So, what if the economy suddenly bounces back? Can we actually reverse this loss later on?
Yes, absolutely. Well, except for goodwill. Goodwill impairment is completely permanent. No going back.
To wrap up, never use undiscounted cash flows. Value in use always equals discounted cash flows. Lock it in.
Keep this in mind. Impairment hits when carrying amount beats recoverable amount. Hurt the goodwill first. Master FR with my paid PDF notes. So, what other hidden financial reporting disasters are waiting for you?
Valuing a company? Listen up, because using the wrong risk-free rate is a massive trap. Seriously, one tiny slip up here absolutely ruins your entire whack. It breaks the whole valuation. So, what's the fix? Always ensure your rate perfectly matches the actual details of your model. First up, you absolutely must match the exact time horizon. 10-year project, 10-year bond. Second, never mix up dollars and euros. Match the location and currency of your project cash flows. Want to bulletproof your financial models for sure? Download my paid FM notes. The link is below.
Let's talk audit and assurance. In your exams, never rely just on written management representations.
You absolutely need actual independent audit evidence. Grab my paid notes and let's verify a client's whack together.
So, in this explainer, are you struggling to believe the whack your client claims? We've all been there.
You're definitely not alone. Expert Xiang Yang spent a whole decade navigating this frustrating, totally subjective maze. The whack formula balances debt, equity, and the tax shield, but man, those inputs are highly subjective.
For instance, clients often just slap on a bank loan rate, but WAC actually needs to reflect business risk.
Let's quickly explore 7 common errors that totally distort fair value financial reporting, starting with market risk.
Error 1. For market risk premium, look at their actual country of operation, not just where they registered.
Second, for capital structure, regulators demand market values for debt and equity. Never settle for just book values.
Third, watch that tax shield. Using effective tax rates actually overstates WACC. Always apply the marginal corporate rate.
Other sneaky traps? Mismatched horizons, inconsistent betas, and ignoring country risk? These literally distort true capital costs.
Here's the golden rule. You must figure out what an unrelated third party would invest at arm's length. So honestly ask yourself, are your chosen inputs truly up to date and relevant to those specific cash flow risks? To fix this, tools like WASA Finder help you source independent inputs, completely doubling your impact and stakeholder trust. Claim a free 30-minute WAC Finder discovery session today. How will you optimize the evidence in your next valuation?
All right, let's dive right into this explainer. Today, we're undertaking a cinematic deep dive into arguably the absolute most powerful force in finance, the time value of money. But look, we aren't just going to sit here and stare at dry equations. We're using this brilliant dual iterative framework to master advanced financial concepts and executive English fluency at the exact same time. It's a method that takes complex data, turns it into a compelling narrative, and then elevates that narrative into high-level institutional analysis.
Now, you might be wondering, why start with a story? Well, there's actually some fascinating science behind this approach. Research from Anna Maria Lusardi over at the Stanford Graduate School of Business proves that financial storytelling creates a mental map that actually lowers our cognitive load. Think about that for a second. Your brain literally works less hard to remember complex data when it's wrapped in a human narrative. It gives us this meaningful, sticky context that raw numbers just completely lack. And honestly, this is our ultimate tool for building true executive fluency.
So, here is our roadmap for today. We'll start with a dual iterative approach, walk through a really relatable story about a wedding gift, pivot over to an institutional CFO analysis, do some shadowing for linguistic mastery, and then wrap up with our final cognitive climb. Let's get to it.
Starting off with Iteration A, Life Literacy, and the story of Kate and Sam.
So, picture this. You've got a young, ambitious, 25-year-old newlywed couple. Let's just call them Kate and Sam. They've just hit this incredibly human, incredibly relatable financial crossroads. As a wedding gift, they receive exactly $5,000 in cold, hard cash. Boom! Suddenly they've got a serious influx of capital.
And that brings us to the ultimate question. What do they actually do with the money? Do they just spend it right away? Maybe splurge on a massive honeymoon upgrade to Bora Bora? Or do they delay that gratification and plan for the future? This single choice, this exact fork in the road, is literally the foundation of wealth accumulation. Well, they choose to invest. And to map this out, they use a brilliantly simple mental shortcut called the Rule of 72. Have you heard of this? Basically, if you divide 72 by your annual fixed interest rate, you get the exact number of years it's going to take for your money to double. So, at a 6% return, 72 divided by 6 is 12. That means without them lifting a single finger, that $5,000 naturally accrues to $10,000 in exactly 12 years. That is the time value of money in action. Money today is simply worth more than that exact same amount in the future, just because of its sheer potential to grow.
Moving on to Section 2, the bridge, where we elevate the narrative.
Okay, so now we're shifting out of the living room and stepping right into the boardroom. We're taking that exact same concept, growth over time, but we're contrasting our everyday life vocabulary with advanced, technical, professional terminology. So a gift suddenly becomes an equity injection. Doubling over time, that turns into accruals and yield curves. And because the underlying core logic is absolutely identical, your brain safely absorbs this advanced jargon without getting lost in translation.
Which brings us to Iteration B, the institutional view and the CFO analysis.
All right, we aren't Kate and Sam anymore. Now, we are the Chief Financial Officer, and we're evaluating a massive corporate project. You see, institutions don't just look forward. They actually look backward from the future using what's called discounted cash flow, or DCF, analysis. They forecast exactly how much cash a project is going to generate years down the line, and then they discount it back to figure out what it's actually worth in today's dollars.
To run a DCF in the real world, we first have to forecast the free cash flow to the firm.
We start with operating profit after tax, we add back non-cash charges like depreciation, and then subtract capital expenditures and any increases in working capital. But hey, listen closely here because this is where even seasoned analysts sweat a bit. Notice what is completely missing from this calculation. Interest. Since we're calculating the cash flow available to all investors, deducting interest at this stage is a massive, fatal modeling error. You definitely want to avoid that trap.
So once we have those future cash flows securely modeled out, we discount them using the weighted average cost of capital, or WACC. This represents the blended overall cost of a company's debt and equity. Think of it as the ultimate hurdle rate, right? If our project's return doesn't beat this WACC, well, it is flat out destroying shareholder wealth. No two ways about it.
Now, to make these really dense institutional metrics stick, great CFOs rely on analogies. They bring the boardroom back to the living room. For instance, if you want to explain a highly leveraged capital structure, meaning a really high debt-to-equity ratio, you could just describe it as carrying 2 backpacks instead of 1. It's brilliant, right? It immediately, viscerally communicates the added weight and risk on the company's shoulders, ensuring total comprehension across every single level of the organization.
Okay, Section 4. Shadowing for linguistic mastery, building prosody and automaticity. Because understanding the math is really only half the battle. The rest is confident delivery. So we're going to use an auditory technique called shadowing. I'm going to say a crucial phrase twice, and I want you to mimic my pacing, my pauses, and my stress to build up that executive prosody. Ready? Let's do it. Discounted cash flow determines intrinsic value. Discounted cash flow determines intrinsic value.
Awesome. Let's try another high-level collocation used in boardrooms everywhere. Shadow me to build that automaticity so you literally never have to hesitate or translate in your head. Ready? Mitigating risk and leveraging assets. Mitigating risk and leveraging assets.
And finally, Section 5, the final cognitive climb, merging story and structure.
By repeatedly moving from a relatable human narrative, like Kate and Sam's wedding gift, all the way up to the technical forensics of a DCF, and physically practicing the phrasing along the way, we achieve our final cognitive climb. This framework grants you a level of influence that is completely indistinguishable from native executive speakers. It literally turns passive data into persuasive strategy. So I'll leave you with this final thought. Now that you have the framework to master both the math and the messaging, are you ready to shape the financial conversation or just listen to it?
Welcome to This Explainer. Let's dive right into the top 3 financial reporting traps killing your exam marks. Studying financial reporting is a frustrating, caffeine-fueled maze, but hey, you are absolutely not alone in this. Let's kick things off with trap number 1. I call it the WACC illusion. People constantly think they can just ask their banker for the current loan interest rate. Wrong. Loan rates reflect credit risk. WACC actually demands a higher cost for your business risk. Fair value reporting needs third-party, arm's-length rates. Don't rely on parent company discounts or just guess. Okay, moving to trap 2, the infamous revenue trap. This one is super important. Never recognize your revenue just because you sent the customer an invoice. Under IFRS 15, you must only recognize revenue when the customer actually obtains control of the goods. Or your timing will be completely wrong. Seriously, grab my paid FR notes. Just follow the 5-step model. Identify the contract, the obligations, determine price, allocate it, then recognize. Finally, trap number 3. This is a big one, confusing audit risk with business risk. What's wild is the stark, point-scoring contrast between these two concepts. They are not the same. Writing down a business risk like struggling to pay suppliers, that literally gets you 0 marks. But audit risk focuses on financial misstatements, like overstated receivables. That's what the examiner actually rewards. To crush this, you need to think exactly like an examiner, using ultra-fast one-line summaries. Like IFRS 16 means right-of-use asset plus liability, and IAS 37 means present obligation equals provision. So ask yourself, are you actually applying this standard, or are you just guessing the rules? All right, let's dive right into the transfer pricing trap. It's a huge pitfall in advanced performance management. Seriously, are you making a fatal mistake with your divisional managers? Let's find out. First, the basics. Transfer pricing is simply the internal price charged when one division sells to another. The acceptable range? Well, the minimum is your variable cost, and the max is the external market price. Never force an internal transfer price on your divisional managers when an external market already exists.
You must use the external market price to maintain divisional autonomy, otherwise you risk destroying their performance and motivation.
Grab my paid APM notes. So why does forced pricing fail so badly? Honestly, it creates massive, unnecessary managerial stress. It totally violates the controllability principle. Managers should only be judged on things they can actually control. If you force a price, the buying division's profit basically becomes uncontrollable. It completely invalidates their metrics. This fallout leads to major dysfunction, like gaming the system, short-termism, and padding out budgets. The tricky part, balancing strategic factors like divisional autonomy against tax efficiency and currency risk. Look, you might want global tax efficiency, but you absolutely cannot sacrifice local autonomy to get. So how on earth do we keep both the buyer and the seller perfectly motivated? Enter dual pricing. Let's see how recording two different prices builds a fair system for everyone. With this setup, head office steps in with a strategic subsidy to bridge the gap. Imagine Division A's variable cost is £10, but the external market price is 18. Division B buys externally for 18, so head office sets the internal transfer price right at 14. Boom, Division A makes a profit, Division B saves money, and both teams stay highly motivated. The golden rule here, design your performance systems to motivate your people, not to manipulate them. So will your next internal price drive strategic growth or completely destroy a division's morale?
Ever wonder why your trial balance perfectly balances even after a massive accounting mistake?
Let's say you buy a brand new machine, but totally mess up the bookkeeping entry.
You accidentally log that major asset purchase as a simple repair expense.
This one tiny slip-up absolutely ruins your final profit figure.
Crazy enough, your checklist looks totally fine. Your debits and credits still perfectly match.
But wait, here is the real catch with this.
You just committed the deadly error of principle.
The books balance purely because you dumped it into the wrong account class.
Grab my paid FA Notes explainer to pass. So, what other hidden errors are lurking in your books?
Okay, listen up. A perfectly balanced trial balance, it actually means absolutely nothing. Seriously, massive exam-failing errors can hide right in plain sight. It's crazy. Like completely omitting an entire business transaction from your records. Poof, gone. Or maybe you accidentally swapped your debits and credits around entirely. What if you just missed a purchase invoice altogether? Happens all the time. But hey, here's the catch that literally traps so many students. Even with those huge mistakes, your trial balance will still perfectly balance. It's literally just a math check, guys. It is not proof that you're right. Want to master this fast? Check out the full explainer and grab my paid PDF notes. Because if your trial balance is lying to you, are you truly ready for exam day? Quick heads up. Think you can just rely on old rules? Nope. Tax thresholds completely change every single Finance Act cycle. Using last year's book? That's literally a guaranteed way to bleed really easy calculation marks on your exam. So why risk failing over outdated info? Seriously, don't. Grab my fully updated TX notes right now.
Studying for the TX exam? Don't let the company car tax relief trap completely destroy your score. So you buy a brand new business car, right? You probably assume you can claim the AIA immediately.
It seems super logical. Just deduct the full cost from your profits to get instant tax relief.
But hold on a second. Here's the massive catch that examiners literally always use to trick you.
Cars are strictly excluded from the AIA. That 100% allowance is meant exclusively for normal machinery. Instead, you've got to use the normal capital pools for cars, which are entirely based on CO2 emissions.
50 grams per kilometer or less gets you 18% relief in the main pool. Over 50, just 6%.
That is a huge drop in relief. Falling for this exact illusion absolutely ruins so many exam scores.
Don't lose easy marks like this. Go download the paid TX notes right now to prep properly.
But honestly, it makes you wonder, what other fatal tax traps are quietly hiding in your next exam?
Imagine working relentlessly, but getting blamed for falling profits caused by costs totally outside your control. Unfair, right? I mean, does it make sense that managers lose hard-earned bonuses over apportioned head office costs? Absolutely not.
Okay, let's dive into this. The controllability principle fixes this by evaluating managers only on choices they actually make.
Count direct costs they control. But old asset depreciation or central rent, ignore those completely when calculating bonuses.
Plus, using fair evaluations brilliantly stops managers from making bad, dysfunctional choices like gaming the system or short-termism.
Conquer your exam anxiety. Grab my APM revision PDF right now to master this and pass with flying colors.
Welcome. Let's dive right into the fascinating world of employee drive and unlocking real motivation. So, why are your well-paid employees suddenly underperforming? The answer might actually surprise you. It literally comes down to motivation. That's simply the willingness of your people to work effectively. But here's the catch. We're contrasting a basic paycheck with the higher psychological needs required for real drive. A basic salary alone just isn't enough, guys. It honestly only covers the absolute baseline. Enter Maslow's hierarchy of needs. This is a brilliant 5-step framework for unlocking that ultimate drive. Level 1, basic needs satisfied by salary. Level 2 is safety fulfilled by solid job security. Right. Next is the social level. Team bonding exercises perfectly satisfy this vital need for belonging. But what truly drives peak performance? Well, we've got to look higher up the pyramid. The real secret? True, lasting motivation lives exclusively right up here in the top 2 tiers. Level 4 is esteem. It's that deep psychological need for recognition and truly feeling valued. For example, a team promotion? Boom. That satisfies the esteem need instantly, making people feel incredibly valued. Okay, watch out for this classic exam trap. A salary increase is just basic. Promotions target esteem. Finally, level 5 is self-growth. This is the ultimate peak an employee's need for ongoing personal development. So, the takeaway is super simple. True motivation is the literal engine driving employee performance. To master this topic completely, definitely check out the rest of this explainer and download those notes. I'll leave you with this. Are you just feeding basic needs, or are you fueling true growth? Simple NPV completely fails complex AFM questions, guys. Why? Because it ignores how debt changes a project's true value. Mashing your operating cash flows and financing effects together, that guarantees a fail. You need a scalpel, right? Enter Adjusted Present Value, or APV. This is your ultimate surgical tool for those brutal exam valuations. APV's real superpower is that it cleanly severs the operating value from all those messy financing side effects. Step 1, just calculate your base case NPV assuming the whole project is entirely equity financed. Easy, right? Step 2, add the present value of any financing perks, like that massive debt tax shield. Step 3, make sure you subtract those nasty debt issue costs that always eat into your margins. Finally, add in any PV subsidies. This equation right here, it's your blueprint for totally dominating those exams. Don't let complex debt ruin your next valuation. Go master this in my full AFM explainer right now.